Well, we do think that inflation is going to fall quite rapidly, almost from from the next release onwards, which is due in 2 weeks. And the reason for that is...
You didn't think that last time?
No, not rapidly. We did think that some more was going to come out, but the rapid sort of fall starts... It's a rather mechanical point, but it's the big annual increases of this time last year that start to fall out of the annual calculation. And it's really to do with energy prices and to the way the Ofgem process worked a year ago. So that's the thing that's going to change, and that doesn't happen until the April data, which will come out in a couple of weeks' time. So that's what we expect to happen. The economy has been more resilient. I think that's good news. I think there's a number of reasons for that. Energy prices, of course, have come down a lot, which has eased the cost of living from that point of view. Fiscal policy is more supportive after the budget, and the world economy is more supportive. China's got out of its zero COVID policy with less disruption than we feared. So there's some good news there.
But it seems like a lot of people looking at the headlines here, they'll have seen this biggest upgrade from the bank in a long time for the economic growth numbers. But they'll be feeling the squeeze, and the squeeze is intensifying, and it's intensifying in part because of what the bank is doing, which is raising interest rates.
Yes.
And there's more of that pain to come through for a lot of households in terms of what they're going to be feeling with their interest rates coming up. Is that right?
Yes. Well, and the reason for that is that the mortgage market has changed a lot in now nearly 20 years, actually, since there was the previous real tightening cycle of interest rates, with interest rates going up. So, of course, we now have a much more fixed rate dominated mortgage market. I think around about 85% of mortgages in this country are now set over a period. Obviously, it can be 2 years upwards, but 5-7 years. What it means, though, is that these the mortgage costs adjust a bit more slowly. Sometimes it varies, obviously, depending on the mix of mortgages we have, but it's coming through more slowly. Now, we factor that in because we know that by the end of this year there will be a lot more mortgages that will reset because fixed rate periods will end.
For millions of households.
And so we factor that in.
But so how much of the pain have we had so far on that, and how much is yet to come?
Well, we think, in terms of resetting and adjustments, it's probably not more, about a third possibly come through.
So only a third so far.
Obviously, by the way, it's a bit more complicated because obviously, as we raise rates, then
yeah. But just in terms of what families can expect, so there is still 2/3 of the kind of interest rate related pain yet to come.
There's quite a large number of quite a large proportion of mortgages yet to reset.
And just looking more broadly at what's happened, to the economy. Are the British people poorer as a result of what we're going through right now?
Well, I think we have to be careful with the choice of words here. What we've had is, because so much of this inflation is coming from external sources, and there's two huge shocks been going on in the world. We've had the largest, the biggest global pandemic for 100 years. We've had, sadly, well, both of them are sad, we've had the largest war in Europe since the Second World War. Now, that has caused an increase in the price of things we import. It's caused a reduction in our real national income because of that, and that comes through with higher inflation from the things that we import. That has reduced national income. We can't, I'm afraid, make that go away, and we have to deal with it. So national income...
So we are poorer as a result.
And we are very sensitive to the fact of the impact this has. It's reducing our national income. And I'm very sensitive to that, and I'm also at that I'm very sensitive to the fact that because it's so concentrated in what I call the essentials of life, in energy, food, that it affects those less well-off households more because they have a bigger share of their consumption in those essentials.
Because for a lot of people, again, they're looking at you in this kind of gilt-edged room in the middle of London. Yeah. And up around the country, people are really struggling right now.
Yes.
Do you see that and relate with that?
I do. And I'm very, very sensitive to this fact that this shock has reduced our national income through higher inflation. And I'm afraid the Bank of England doesn't have a tool to make that go away.
Can you help?
Well, what we have to do is stop it becoming persistent.
Right, but can you help with, there are particularly some families who are, particularly struggling right now. Some people don't have mortgages, some people have lots of savings. Actually, this has been not bad, relatively speaking, for some people. But for some people, it really has been quite tough. So can you kind of focus on those people and really help?
Well, I think it's not something, I'm afraid, that monetary policy can address, because monetary policy is an economy-wide tool. I have to be.
So it's not for the bank, but it's for the government to do
something.
Well,
it's not for me to prescribe what others should do in that situation. I think it's for others to use policy tools as appropriate, and that's an appropriate policy process. What is crucial is that we use monetary policy to prevent it becoming persistent, because the hardest thing I have to say is that makes it worse.
So, final thing, today you're talking about the fact that food price inflation has been higher than expected. You've had to upgrade or raise your inflation forecast. Before it was, Putin, before it was energy. People are looking at the bank, they're looking at your inflation forecast, and they're saying you keep getting it wrong. I mean, is the simple truth here that basically the bank isn't very good at forecasting?
I don't agree with that. I want to be very clear. We're experiencing huge external shocks coming into the economy. We're not alone in this. I mean, other countries obviously have got the same situation. Those external shocks are, frankly, not something you can forecast as such.
Things like the war.
Something like the war, you can't forecast wars.
But the bank was missing its forecasts before the war. It was missing its forecasts before the big rise.
Yes, because there was an impact from
in 2021.
There was an impact from COVID on what we tend to call supply chains, on the supply of goods into the world economy, actually. Now, that was the first shock we dealt with sort of post-COVID. What I think has been particularly difficult in this situation is that we've had this succession of big shocks with no gaps in between, and we've had to deal with those. And we've had to adapt policy as those shocks and their effects have come along. And I also would fully recognise we learn things about those shocks as they go on. So the transmission of food prices, it's going to take longer for it to work through. It's not that it is going to become persistent in the sense of never going away. All the food producers and retailers I talk to say, no, it is going to come down this year, but it is taking longer. That, I think, has some things to do with the nature of the shocks that we're experiencing, and particularly, I'm afraid, sadly, how the war in Ukraine has fed through into elements of the world economic system.
But you're pretty sure you've got it twigged now? We can trust you now on the inflation forecasts?
Well, we are very sort of firmly behind the view we have now, which is why we've changed, we've moved rates today. I've been very clear, though, that our future actions will be driven by the evidence. That's very clear, and the evidence will move on. I hope the evidence will show inflation, as I expect, inflation starts to come down quite sharply, and that this resilience in the economy continues, because that is helpful.